Yesterday, India signed one of the biggest trade agreement in recent years with the United Kingdom. Now, here is the interesting part. Almost every product that India exports to the UK will now enter the UK market without paying duty. I mean, import duty. But the bigger question is which Indian industries stand to gain the most? Most important, which listed companies would be the biggest beneficiary over the next 5 years? Let's understand this in simple language. Hello, everyone. Welcome back to Investing with Anik. Whenever such trade agreements are signed, newspapers simply mention that exports will increase. But as investors, our job is different. We need to understand which sectors benefit, why do they benefit, and which companies could gain from this opportunity. So, in today's video, we will be decoding the India-UK Free Trade Agreement from an investor's perspective. Hi, I'm Anik Mitra. I'm a SEBI-registered research analyst part-time, having my registration number INH 0000231880. I have a disclaimer that I do not have any buy, sell, hold recommendation through this particular video. The stock which I'm going to mention here are not my recommendation. This video is made absolutely for academic purpose only. The stocks I'm going to mention are simply the expectation from the agreement which came in front of us. So let's begin. First understand that with a free trade agreement, what would be the impact overall? Suppose India exports a shirt worth 1000 rupees to the UK. Earlier, UK government charged certain import duty, maybe 10%, 15%, 20%. That used to make our product costlier. Because of the duty, the shirt became more, means what I mean to say, because of the duty, shirt used to become more expensive for British buyers. But now, under this agreement, import duty on almost all Indian producers has either been eliminated or significantly reduced. That means Indian products become cheaper in the UK. And whenever price fall, demand generally increases. Higher demand means higher exports. Higher exports can translate into higher revenues, higher production, higher capacity utilization, and eventually higher profits for the companies. There are four major highlights. The first one, nearly 99% of India's export to the UK will enjoy duty-free access. This covers almost the entire value of India's export. Second is the agreement also opens opportunities for service like IT, financial services, professional services, education, business consulting. Third, a very important provision called the double contribution convention. Contribution convention, DCC. Suppose an Infosys employee goes to the UK for a 3-year assignment. Without this agreement, both the employee and employer could end up paying social security contributions in both of the countries. Now, for temporary assignments up to 5 years, they can continue contributing only to India's social security systems. This reduces cost for Indian companies. And fourth one, according to the UK government, the agreement could increase annual trade between both of the countries by more than 25 billion pounds over time, while adding nearly 5 billion pounds to the GDP of both of the countries. Now, question is, which sector is going to be benefited? Now, let's discuss the sectors. Engineering sector. Engineering goods are India's largest exports to the UK. This include industrial machinery, boilers, mechanical equipment, capital goods, companies manufacturing these products become more competitive because of lower duties. Companies to watch include Larsen Tobro, Thermax, Cummins India, Bharat Heavy Electronics, and several other engineering exporters. Another one sector which is likely to be benefited is auto component. This is the sector I am personally very positive. India has become a global manufacturing hub for auto components. As exports become more competitive, companies supplying precision engineering products like forging, castings, electronic components could benefit. Some listed names include Endurance Technologies, Minda, Sona BLW, Motherson, Bharat Forge, Suprajit Engineering, they are likely to be beneficiary of the arrangement. Here, I would like to mention that I'll be starting a complete auto ancillary series from next week where we will discuss these companies in details. In the last video, I have already discussed on endurance technologies. If you have not seen this video, then please spend some time on that one. The next sector I'm going to discuss, that is textile and apparel. India already has strong capabilities in garments and textile. Duty-free access makes Indian products more competitive against countries exporting to the UK. Companies like KPR Mill, Gokuldas Export, Arvind Limited, Vardhaman Textile would benefit over the long term. Even companies like Malcolm, who have strong exposure in the UK, in the Europe market, also may get benefited. Leather products also are beneficial, may emerge as a beneficial. Indian leather products have significant export potential. Companies involved in footwear and leather exports could gain from this. Companies like Red Tape uh, already has significant exposure in the UK market. Gems and jewelry is one another area in focus. India is one of the world's largest exporters of gems and jewelry. Lower import duties can improve competitiveness in the UK market. Companies such as Titan Jewelry Exports, Vivav Global, and other exporters may benefit uh, depending on the UK exposure. Chemical is also a space where we can have a look. India has become an important supplier of specialty chemicals globally. Export-oriented companies like uh, with UK customers may benefit over time. Then comes marine products. Indian seafood exporters become more competitive. After US imposed tax on India, Indian companies started looking for or started diversifying uh, to the European market. On that backdrop, in FY26, Indian companies benefited significantly by exporting uh, or new destinations like Europe, or increasing exposure like exposure in European countries and also in Africa. So in this context, UK can be a good market for these players. Then comes processed food, packaged food, ready to eat meals, spices, processed agricultural products would witness stronger exports. Even rice also should not be ignored. Then comes IT services. Now it's not product, it's services. IT services, the agreement is not only about goods, it's also improves opportunities for IT companies, consulting business, engineering services. The double contribution convention is particularly beneficial for companies that frequently send employees to the UK. Companies like TCS, Infosys, Wipro, HCL Tech Mahindra could save cost on temporary overseas assignments. Although uh, the amount compared to their total revenue may be very negligible, and that's why exposure means this benefit may not be reflected in the numbers of the companies. India's existing trade with UK is also an area where we should have a look. So now this is the time. Let's have a quick look into the existing exposure of Indian companies or India in the UK market. India exports goods worth, India exported goods worth around $13.4 billion in FY26 to the UK. Engineering goods contributed around 17% of export. Electrical machinery contributed around 10%. Apparel and garments together contributed nearly 11%. Interestingly, despite these trends, India's export to the UK declined by around 7.6% compared to FY25. This trade agreement would help reverse the trend over the coming years. Now, question is, will every company benefit immediately? Now, one important point to remember, many investors assume that the day on FTA is signed, uh, every stock in these sectors should rally. This is not how business works. The actual benefit depends on how much revenue a company earns from the UK, whether it has more manufacturing capacity, it is pricing power, its competitiveness, and how quickly new export orders materialize. So, agreement creates an opportunity, but companies still need to execute well. And also, what I was referring to, that was the contribution. How much contribution, how much exposure the company has in the UK market, and how much potential the company has to enhance that opportunity, or how well poised the company is to take the opportunity. These things must be remembered. So to summarize, the India-UK Free Trade Agreement is a long-term positive for India's export-oriented economy. Engineering goods, auto components, textile, leather, chemicals, marine products, processed foods, IT services all stand to benefit over time. However, as investors, our focus should now shift from sectors to individual companies, because not every company will benefit equally. If you found this analysis useful, do hit the like button and subscribe the channel. And don't miss the next week's series on auto ancillary companies, where we will take a deep dive into the business. Like endurance technologies, already we have done. Next, Minda, Sona, BLW, Bharat Forge. As time would permit, I shall keep on adding uh, these in the series, and to understand which companies are best positioned for India's manufacturing and export growth. That also will be clear over the period of time. Thank you for watching. I will see you in the next video.